day, everyone, and welcome to the premium video newsletter for Tuesday, September 17th, 2013. Right now, the markets are waiting for the FOMC decision and are quieter than usual. But there's always lots going on, so let's dive into the fundamentals and go from there. Markets were trading in a narrow range Tuesday as traders geared up for one of the biggest economic events of this year, the likely reduction in the U.S. Federal Reserve stimuli program. The subdued tone in the financial markets came one day after stocks rallied and the dollar slipped on the decision by former U.S. Treasury Secretary Lawrence Summers to rule himself out of the race to succeed Ben Bernanke as Fed chief next year. Investors concluded his withdrawal as a means that the Fed's stimuli will last longer than if he had taken the position as the next Fed chief. Recent polls showed a majority of U.S. Treasury primary dealers believe the Fed will scale back their bond purchase program by $10 billion to $75 billion every month from the current $85 billion per month. U.S. home builders' confidence in the housing market held this month at the highest level in nearly 8 years. But builders are starting to worry that sales may slow if mortgage rates continue to rise. The National Association of Home Builders Wells Fargo Builder Sentiment Index stayed at 58, the highest since November of 2005. Mortgage rates have risen more than a full percentage point since May, when Federal Reserve Chairman first indicated that Fed could slow its bond buying program this year. The August Consumer Price Index was up 0.1 when 0.2 increase was expected. And that's the only news we got today from the Feds. Since bonds and stocks have the biggest impact from the FOMC, I will start my analysis with the bond market, which traded higher on news that the Consumer Price Index increased less than anticipated. The bond market is going to move tomorrow and the day after. The question is how much is priced into the market and what the outcome of the FOMC is. If the Feds don't begin decreasing within the next few months or decrease less than $10 billion per month, the odds are high that we will rally pretty hard. However, if the news comes out that we're going to cut aggressively or more than the $10 million per month as anticipated, the bond market is going to fall hard and fast. I will update you tomorrow morning, but the best clue right now is the low made yesterday and the day before. Let's see if we can hold the low or break it, because if we break the low, the odds are high that we will continue moving in that direction. And remember, markets resolve in the direction of the major trend, and the trend in the bond market is down. So even if the news is not what we're expecting and bonds do rally, it won't be for a long time. And remember, bonds are very forgiving and they're very choppy, so don't overreact to their movement. For the most part, the stock market was very quiet today as all eyes are focused on the FOMC tomorrow. We didn't see much action today in most indexes and subsectors, but we did see the semiconductor sector pulling above yesterday's high price. This is a bullish indication and gives us some preliminary clues as where the stock market may be heading. The broad market is not as strong in the Nasdaq, and although the strength was in the broad market a few days ago, it seems like we once again shifted to the Nasdaq for the majority of the accumulation today. Notice the transports, which are leading subsectors, are down today and begun filling the gap to the downside. This tells me that the strength we saw in the broad market is diminishing once again. Even the home builders who exhibited extremely strong numbers earlier today couldn't break yesterday's high. This gives me more pause as to the strength of the broad market, and more importantly, I believe traders are on the sidelines waiting to get better indication of the outcome from the FOMC. Also remember that the FOMC is going to influence the broad market significantly more than the tech stocks. There's substantially more interest rate related stocks in the broad market, so it makes sense that we're seeing more strength in the tech sector, at least for now. Moving on to the foreign currency market, the euro is higher after an index of German investors and analysts' expectations in September increased to the highest level in over 3 years, and that's significant, folks. Gains in the euro were limited, however, by a report that showed Eurozone exports declined 1.6% in July from the previous month. The euro is very dependent on the US dollar and the FOMC as a result, especially during the next few days. I believe most of the FOMC is priced into the currencies, and we won't get much of a surprise tomorrow. But if we do, we may get some volatility in the euro because it has strong relationship to the dollar, and it has more exposure than any other foreign currency to the US economy. If the Feds leave things alone till next month, the US dollar will rally and the euro will fall. And if the Fed surprise us and decide to cut more than anticipated, expect the euro to rally strongly. The British pound maintained its strength in spite of a report that showed UK inflation in August slowed down. Consumer prices in the UK increased by 2.7% from a year ago, but the pound is trading more on technicals right now. The RSI is still overbought, but we're still holding strong, which is impressive. My logic in regards to the pound is simple. We rallied strongly, irrespective of the US dollar, and I think the FOMC is less important to the pound than to the euro. Therefore, I think we will be less impacted by the fundamentals when it comes to the pound than most other major currencies. However, we're still overbought, and I do think the pound is going to take a breather. I don't know how far the retracement will be, but the first line of support is at the 158 level, and this is the level we want to focus on for the next few days. The first setup for tomorrow is a tail gap to the downside. The ticker symbol is CHS. Place a sell stop 15 cents below today's low, and if filled, place a buy stop 15 cents above today's high. Remember, this is a stock, so if no fill by lunchtime tomorrow New York time, cancel the order. The second setup is a 4x4 to the upside on ticker symbol TNGO. Place a buy stop 25 cents above today's high, and if filled, place a sell stop 15 cents below today's low. I'm giving this trade a bit more room before the entry signal because it's sitting at a breakout level, and I want to make sure the breakout is not a false one. Remember also, if no fill by lunchtime New York time, cancel this order. That's it for today's tutorial. I will update you midday tomorrow and earlier if I see something developing with the FOMC that you should be aware of. Have a great night, everyone.